Let's jump right in. If you've been following the financial news lately, especially around April 2026, you've probably seen some seriously scary-sounding headlines about the Federal Reserve's balance sheet. In this explainer, we're doing a deep dive into what actually happens when the most powerful central bank in the world starts, well, losing money.
I mean, just look at this staggering number, negative $243 billion. Let's be honest, for literally any normal company out there, seeing a massive pink warning sign like that on the balance sheet would absolutely mean game over. The doors would be locked.
Which naturally leads to the elephant in the room, and the question you're probably asking yourself right now: is the Federal Reserve actually bankrupt? Like, has the US central bank officially run out of money? It's a wildly provocative thought. But to get to the truth, we need to strip away all that dense accounting jargon and look at the actual mechanics of what this negative $243 billion figure really means.
Okay, so here's our agenda for unpacking the whole thing. First, the Fed bankruptcy myth. Second, how the Fed makes money. Third, the interest rate mismatch. Fourth, decoding the deferred asset. And finally, number 5, the real physical cost.
All right, Section 1, the Fed bankruptcy myth.
So, unlike a normal, everyday bank that burns through its cash, faces a terrifying deposit flight, and gets shut down by regulators, the Fed operates by a completely different rulebook. Why? Well, it definitely helps when you literally issue the settlement asset yourself. You create the money. There are no margin calls for the Fed. They simply halt their normal payments to the Treasury, keep the lights on, and continue executing monetary policy without missing a single beat. Moving on to Section 2, how the Fed makes money. Before we talk about the losses, we really have to understand the normal engine here. Usually, the Fed is a massive profit-generating machine. It earns a ton of interest on its giant portfolio of securities. From that, it pays its operating costs, pays interest on its liabilities, covers its required dividends, and then takes whatever's left over, the residual profit, and hands it straight over to the US Treasury. So in a normal year, the central bank is actually a huge, reliable revenue source for the federal government.
Which brings us to Section 3, the interest rate mismatch.
So, exactly where did this profit machine break down? It's basically a 3-step fatal trap. Step 1 is the asset leg. Think back to quantitative easing, or QE. The Fed bought up huge mountains of fixed-rate Treasury and mortgage bonds. Step 2 is the funding leg. To pay for all those bonds, they created bank reserves, which act as floating-rate liabilities. And then, Step 3. The trap snapped shut. When inflation surged, the Fed had to aggressively hike its policy rates to fight it. Suddenly, they found themselves paying a massive, high floating rate on their liabilities, while their assets were still stuck earning that old, low fixed rate.
Let's ground this concept for a second. Imagine you went out and bought a 10-year bond yielding a tiny 1.5%, and you funded that purchase entirely with overnight borrowing. At first, borrowing was virtually free, let's say 0.1%, so you're happily pocketing the spread. Nice and easy. But then, bam! Your overnight borrowing cost suddenly shoots up to 5%. Your bond is still only paying you that measly 1.5%, but your debt is costing you 5%. You are bleeding cash every single day. Multiply that exact dynamic to a multi-trillion-dollar scale, and that is precisely the mismatch the Fed ran right into.
To put some concrete numbers on this, by March 2026, the Fed's administered rates, the actual tools they use to steer monetary policy, had climbed significantly. They were paying 3.65% interest on reserve balances right to the banks and offering 3.50% on the overnight reverse repo facility. Those rising rates acted like rocket fuel for their liability costs. And when you look at the audited financials for 2025, reality really sets in. The Fed actually brought in a massive $155.2 billion in interest income. That's huge. But here's the kicker. Their total interest expense rocketed to $167.3 billion. The expense line just completely overtook the income line. That created a net interest expense shortfall of over $12 billion for the year. Just like that, the profit pipeline flowing to the US Treasury was completely shut off.
Let's move to Section 4, decoding the deferred asset. Okay, so deferred asset. It sounds like awful accounting jargon, right? But honestly, thinking of it as Treasury remittances prepaid in reverse makes it instantly click. It's absolutely crucial to understand that this is not some pile of cash that taxpayers suddenly owe the Fed. No way. It simply means that when the Fed finally does return to making a profit, every single dime of those future earnings has to be kept in-house to repair this accumulated shortfall. Only after this deferred asset is fully paid down to zero will the Treasury start getting its checks again.
If you're someone who geeks out and looks at the weekly Federal Reserve H4.1 report, you'll see a specific line item for remittances due to the Treasury. Normally, that number is positive. It's the estimated weekly profits heading to the government. But when it flips negative, well, that negative cumulative number is exactly what the deferred asset is. Remember that giant negative $243 billion figure we looked at right at the start? Yep, that's the exact hole we're talking about filling.
Actually, quick side note here, because it's vital we don't mix up two very different types of losses. What we've been talking about are operating losses, the income statement shortfalls that halt Treasury payments and grow the deferred asset. But you might have also seen headlines about a staggering $844.2 billion unrealized loss. That is totally different. That's just the mark-to-market drop in the value of their older bonds because interest rates went up. And since the Fed holds these bonds to maturity and, as we covered earlier, doesn't ever face deposit flight, it's just duration risk. It doesn't threaten their daily operations at all.
Which brings us to our final part, Section 5, the real fiscal cost.
So, the real pain of all this, it isn't actually felt at the Federal Reserve. It's felt over at the U.S. Treasury. Without that normal, steady flow of tens of billions in Fed profits, the Treasury just straight up loses a huge revenue source. We're talking about a very tangible, real-world hole in the federal budget. The direct result of that? Larger government deficits, a need to issue even more debt just to cover the gap, and the total consumption of future central bank income, what economists call seigniorage.
But let's be absolutely 100% clear on this point. The deferred asset is not a taxpayer bailout. The Treasury doesn't have to scramble and write a $243 billion check to recapitalize the Fed today. The central bank literally does not need a rescue package to keep its policy tools functioning. The actual practical cost to you and me as taxpayers is just lost revenue today and delayed revenue later. That's the whole shebang.
However, and this is a big however, just because there's no immediate financial crisis doesn't mean there aren't massive institutional vulnerabilities here. I mean, think about it. The optics of the central bank losing hundreds of billions of dollars while simultaneously paying high interest directly to commercial banks, it looks terrible. It's an absolute PR nightmare. There's a very real danger of the public misunderstanding what's happening. That misunderstanding can easily lead to political attacks and ultimately immense pressure on the Fed's independence. You can easily imagine politicians trying to force the central bank to change its monetary policy simply to patch up its accounting losses.
This quote right here really hits the nail on the head and summarizes the core of this explainer. The Fed is not bankrupt. Treasury is simply not getting paid until the Fed earns back the accumulated shortfall. The institution itself is perfectly safe, but the Treasury? Yeah, they are cut off from their usual payday until this gigantic accounting hole gets systematically filled back in by future profits.
And honestly, that leaves us with a massive, critical question to ponder. As long as this huge deferred asset just sits there on the books, acting like a giant political lightning rod, are these accounting losses going to be used by critics to pressure the Federal Reserve's future monetary policy decisions? It is going to be a fascinating, fundamental test of central bank independence over the next few years. So what do you think? Thanks so much for joining me for this explainer, and remember to always look past the headlines.